After a new all-time high yesterday, futures are down. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, cars, chips, and drugs. President Trump threatens wider tariffs, adding more sectors facing 25% levies.
And we'll talk about the Wall Street payday. Citi's Jane Fraser gets a 33% raise as hedge fund manager Rob Citron makes $730 million for himself in 1 year.
And disappointing debuts. The IPO market off to a rocky start this year, threatening the next wave of offerings. All that and more coming up. But let's take a look at these markets. 30 minutes to go until those bells ring. Like Matt said, we did reach an all-time high yesterday, a fresh all-time high. Small moves, but that's all it takes when you're at these heights. You can see we're taking a little bit of a breather today. Not too much reaction overall to the latest tariff threats coming from the White House. You can see the S&P 500 off by about 0.2% in the pre-market trade. Similar story if you take a look at the NASDAQ 100 and the big tech names that live there. You take a look at the bond market, also pretty well behaved at this moment, though we are firmly in the danger zone, Matt Miller. I don't know if it's still the danger zone if we're at all-time highs.
Yeah, I think, maybe we get used to it at this level.
Normalize.
Exactly. Not too dangerous if you're making that much money. I want to take a look at some companies that may be losing a lot of money if we see these tariffs enacted. These are some of the car makers that have a large portion of their production overseas. Now, I would slide Porsche right in here at the top. P911 makes 0 cars in America, so 100% for them. But Volkswagen in general, 80% of the cars that they sell in this country are made overseas. Hyundai and Kia, 65%. Mercedes, 63%. Renault, Nissan, 53%. I'm surprised that's not more. And then BMW makes more than half of the cars sold in America overseas. So if we get 25% tariffs on cars, it's going to hurt these companies the most.
And as you know, I love my Beamer, so it's very hard news to swallow. But, time is early. Let's see what we see come to life at the end of the day in terms of actual tariffs. We're watching some stocks, of course, still under the market. Matt Miller, it is still somehow earnings season. Etsy is falling after revenue missed estimates, and the company faces significant headwinds for sales, citing a more competitive retail environment. Lot to watch in those consumer stocks. Etsy down more than 7% pre-market. SolarEdge, a smaller company, but it's absolutely soaring. Revenue topped estimates despite dropping 38% year over year. It's up another 28%, 29% pre-market. It has been up meaningfully on the year as well. They also returned to free cash flow as the industry is poised for growth this year. Capri Holdings also watching that, some potential deal activity there, up 3% pre-market. This is on news that Prada is evaluating the Versace brand under the Capri umbrella. Prada has emerged as one of the winners in a global luxury sector downturn. There's no assurance of a deal, but they indeed are looking.
Yeah, and I imagine they would be affected by tariffs as well. Did you see this morning that Bernard Arnault is trying to use his very close relationship with the Trump family to get a little bit of a discount?
I did see that. I was wondering if you were going to ask me whether I saw the news that Trump is threatening tariffs, to which I was going to say, yes.
Yeah, you saw that?
I did. Again. And that is the theme in the market. There was a great note out from Ian Lingen over at BMO this morning talking about this tariff fatigue that seems to have settled across markets. He was talking specifically about the rates market. I think it applies to stocks as well. He wrote that the timeline for implementation and, of course, the non-zero possibility of reversal has really lessened the market impact here. And I feel like today's market action certainly speaks to that as well.
Yeah, it's kind of muted. Let's pull up that timeline. We have some critical dates at least to look out for, March 4th being one of them. That's a pause on tariffs for Canada and Mexico, lifting. So therefore, the discussion would start again. March 12th, tariffs on steel and aluminum begin, allegedly. Well, the thing about the VIX, what's interesting to me is
that now we have the timeline up. Let's do the timeline first, and then we go back to the VIX. April 2nd
is the last day. So between March and April is where we're going to see a lot more potential volatility, and because of it, VIX futures are actually a little higher than spot right now. Nice little arbitrage to play on. As Julian Emanuel says, it's skewed to the upside, that VIX risk.
Really feels like picking up pennies, though. I mean, you take a look at that line, not doing much. I hear what you're saying about the forwards, but still, it just feels like people are really happy to look past these tariffs, look past these threats, and write them off basically as negotiating tactics.
5% the new danger zone? Can we just call it?
Yes,
on the 10-year?
we won't use the term danger zone
It's
on the
over.
10-year until 5%. By the way, is there something, can I just...
You're too short. You look like my little brother.
Sorry.
We liked it that way. Anyways, talking more about tariffs, though that was a nice little break from that. President Trump is in Miami today for the Future Investment Initiative Institute, but everyone is keeping a close eye on those tariff threats. Bloomberg's Tyler Kendall is in Miami. A lot of major Wall Street executives down there for this event. Of course, FII closely tied to Saudi Arabia as well. What are you expecting to hear from the president?
Well, Sonali, we do expect this increase of U.S. investment from Saudi Arabia to be one of the big focuses here. You'll recall that the week President Trump took office, Saudi Arabia's crown prince pledged that they would invest $600 billion into the U.S. That was considered to be pretty substantial, makes up about 55% of the country's GDP. But President Trump said it wasn't enough and that he would like to see $1 trillion invested over that 4-year time frame. Experts tell us that that's pretty unrealistic, but it has helped to reel in some of these big names in U.S. businesses. We're expecting Ken Griffin, Stephen Cohen, the executives of Uber, and Oracle all to be here as they could potentially see some benefits, some upsides from an increased flow of capital between these two countries.
So all the bigwigs down in Miami. Let's talk about tariffs, though, Tyler. We're talking about that 25% on drugs, cars, other things as well. But I want to talk about the fact that Trump said that he wants to give companies, quote, time to come in before he announces these import taxes. I can't imagine that a company could really meaningfully reroute its production capacity in less than 2 months. And I feel like that really gives some weight to the idea that these are negotiating tactics more than anything else.
Right, he outlined that April 2nd date, notably one day after the USTR and Commerce are expected to provide their studies on country-by-country reciprocal tariffs. So it remains to be seen exactly what President Trump is looking for here, right? He often talks about tariffs in 3 sort of buckets: as a revenue raiser, as a way to rebalance trade, and then also as a negotiating tool. So we'll be looking at all of these things and whether or not any countries could move when it comes to domestic manufacturing into the U.S. as President Trump tries to create this idea that he would like to see more investment here. Actually, him talking yesterday saying that he wants to give our trading allies, quote, a little bit of time, a little bit of room, was really one of the first times that we've heard more of a concrete policy initiative from him, besides for just calling on other countries to lower their tariff barriers overall. We know that Bloomberg Economics, for example, when it comes to reciprocal tariffs, has been talking about how these will hit emerging economies perhaps the hardest. But then when it comes to these other tariffs on chips, autos, and pharmaceuticals, we're expecting that to potentially hit Asian markets the hardest. These are some of the countries that we're already starting to see make the phone calls, make the trips to Washington to engage with President Trump.
All right, Tyler, thanks so much. Tyler Kendall there in Florida will continue to cover what's going on with the president in Miami today. But we want to swing back to markets. We have with us here JPMorgan Multi-Asset Solutions Global Strategist David Lebovitz. And David, just to get this tariffs thing out of the way, I mean, we were looking at a picture of the VIX over a year, and it's very sanguine, right?
Yes.
Does no one care? We hit all-time highs yesterday on the S&P on a day when Donald Trump is saying he's going to tariff autos at 25%, which, by the way, wouldn't just hurt Mercedes and Volkswagen, but would be disastrous for Ford and General Motors as well.
So I think there are 2 things that are going on here that's leaving the market, relatively insulated from all of the tariff talk. The first is, if you look back at the first Trump administration, right, a lot of it was negotiation. And so I think part of what the market's doing is taking a bit of a playbook from what we dealt with the first time around. I also think at the same time, when you look at the impact of these tariffs, they're much worse for the rest of the world than they necessarily are for the U.S. economy. And so U.S. markets, and we can talk about the resilience of international markets as well, which has been a bit surprising, but I think U.S. markets are more focused on that fundamental growth story, which, although there would be somewhat of a drag from the imposition of tariffs, it wouldn't be material. We don't see it as knocking the economy into recession.
Well, to that end, when you think about tariffs, if you can't really make a trade today based on what you're seeing out of really the rhetoric that's coming out, they're not implemented yet, how do you hedge these risks?
So it's a good question. I think the first thing that you want to do is understand the probabilities of different outcomes and understand what those different outcomes will mean for the underlying trajectory of growth. Once you have that kind of distribution in your mind, you can come up with a base case view, and relative to that base case view, figure out how to build a portfolio. Unfortunately, given the nature of tariffs and immigration policy, duration isn't really going to be much of an effective hedge going forward in our view. And so, we're looking at other things, alternative types of strategies that maybe zig when a traditional 60-40 portfolio zags, using derivatives to try to pad the upside and the downside. There are ways to protect a portfolio, but overall, we're leaning into risk. We think that there's still an underlying pro-growth agenda, and we think, again, these tariffs are going to be much more punitive for the rest of the world than they are for the U.S. economy.
David, you mentioned the resilience of international markets, and one of the themes we were discussing at length yesterday was the fact that you have Europe outperforming year to date, which I think is surprising to a lot of investors, maybe to some anchors as well. You had a note from Barclays out this morning talking about how the easy gains are over for European equities.
I would agree with that. Europe likes to perform well when nobody's watching is kind of what I've learned over the years. And if you look at what's happened here, valuations have re-rated materially, positioning gaps have closed. I mean, they're not overweight Europe, but they're much fuller on Europe exposure than they had been previously. I think a lot of what's also catalyzed this rally is the expectation that we're going to get some relief around Russia-Ukraine, because what that means arguably is lower natural gas prices, and just like lower oil prices in the U.S. are a boon for consumers, the same can be said about European consumers when it comes to energy costs.
In terms of places where you feel comfortable putting money, what's your strongest conviction? What do you wake up in the morning getting psyched about?
So we've been debating what the overall composition of our risk profile looks like, and we're still overweight equities, but we're also leaning in pretty materially to high yield credit. High yield is a no recession asset class. We recognize that spreads are tight, right? That's the big pushback that I always get when I throw that out there. But if you're clipping a coupon of, call it 7.25 with a third of the volatility of the S&P 500, for us that's a pretty favorable trade to add into a diversified portfolio.
But don't you risk default? I mean, if the economy turns lower, you're at much higher risk than you are in IG.
Absolutely. I would say that we put our recession risk over the next 12 months, or the probability of recession, right around 15%. You also look at where some of the fundamentals are for these high yield companies. Leverage ratios have increased, but the overall level is still relatively fair. Coverage ratios have decreased, but overall the level is fair. Given our view that we're entering this year with pretty significant momentum in the U.S. economy, and that the president does have this America First agenda, again, with recession probabilities low, we're comfortable leaning into high yield. We're not leaning as much into the triple C's as we had been. We're seeing a bit more value in the higher rated parts of that market. But for us, if you look at the way high yield has performed during the bouts of equity volatility that we've seen over the course of the year, frankly, it's been relatively well behaved. And so a nice offset to the overweight equity position that allows us to continue to generate pretty meaningful returns.
Really interesting to hear your conviction on high yield here. Typically, you hear people talk about high yield and small caps in the same breath. Does that conviction you have on high yield extrapolate over to the small cap universe?
So we've been throwing the football around quite a bit about moving down in capitalization away from large cap and specifically mega cap tech. We're a little bit more comfortable with the mid-cap trade than the small-cap trade. For us, small caps are early cycle assets, right? They do well when you're coming out of recession, when the economy has a lot of momentum, when the things that got beat up the most are finally beginning to bounce. And while we're constructive on our view for the economy this year, we don't think this 3% pace of growth is going to be maintained. We think that that's going to gradually step down to 2% over the course of the year. Also, a big part of the reason why small caps ripped at the end of last year was because of this expectation that the Fed was going to do all this easing. Well, the narrative there has changed pretty materially as well. And so while we're not underweight small caps, we're not overweight small caps either. We're relatively neutral, prefer to lean into that higher quality mid-cap space.
Really nice picture here of how to invest through higher for longer. David, we thank you so much for your time.
I was going to ask him about doing channel checks in Vail.
What?
On the consumer at Kemosabe. Do you have any research into that?
I'm familiar with Kemosabe.
They have a great location in Aspen as well.
They do. I think the Vail one is a little bit different. I think it draws a slightly different clientele. But, there's no better indicator than just looking at what's going on around you. I was in Florida last week speaking at a conference. Airports were full. airplanes were full, restaurants are full. The idea that we're on the cusp of a recession here in the U.S., whether you look at Kemosabe or whether you look at the Marriott in Fort Lauderdale, you're going to see the same thing.
But how's the base? Is the base there?
The snow is okay. Hopefully we get some miracle March and that really turns things around.
Yeah, somebody who's going to ski in upstate New York. I'm pretty jealous of all of these conversations right now. Icy mountains. JPMorgan's David Lebovitz, thank you so much for your time this morning. And coming up next, we're going to keep an eye on the auto sector. In the wake of those tariff threats from President Trump, we're going to head to Detroit next. This is Bloomberg.
Get to high interest to look at what's making headlines around the world. Secretary of State Marco Rubio told European allies the U.S. will keep sanctions on Russia until there's a deal to end the war in Ukraine. President Trump said he'll probably meet Vladimir Putin to discuss a settlement before the end of the month. He did say that Ukraine started the war yesterday, which is maybe some misinformation. Meanwhile, EU ambassadors are moving forward with a fresh round of sanctions against Moscow targeting Russian aluminum imports and its shadow oil tanker fleet. In banking, Citi is raising CEO Jane Fraser's total compensation to $34.5 million for 2024. That's a 33% increase from last year. It's the biggest raise for a bank CEO this year. Fraser's pay bump comes as Citi posted record revenue in 3 of its 5 divisions. Fraser also led a drive to shed overseas retail businesses that were underperforming. And Treasury Secretary Scott Bessent says DOGE has saved $55 billion in federal spending so far, but its own website only accounts for $8.6 billion of that. That's a shortfall of $46.4 billion. Bessent also said U.S. taxpayers don't need to worry about the security of their private data while the DOGE team tries to make the government more efficient. Nothing to see here. Just move on, please. President Trump is saying he would likely impose tariffs on cars, chips, and drug imports. He said the announcement could come as soon as April 2nd. Joining us with more on the impact on the auto industry is Bloomberg's David Welch in Detroit. And David, let me start with winners and losers. I immediately thought of Porsche. They make all of their cars overseas. But then Ford, GM, and Chrysler make a lot of their cars overseas as well. How's it look?
They do. Look, the biggest losers would be European automakers. Volkswagen imports, I think, 80% of their vehicles into the U.S. Nissan has a lot of production in Mexico if the tariffs are going to be hit there. And the Korean automakers also import quite a few vehicles. But yeah, Ford, General Motors, Stellantis, they do bring in a lot of vehicles, especially from Mexico and some from Canada. And look, among the domestics, GM would probably be hit the hardest because most profitable vehicles are large pickup trucks. GM has a pickup plant in Mexico, another one in Canada. They do have a couple big plants in the U.S., but you're still talking about very profitable vehicles that would be hit with a 25% tariff. And don't forget parts. We're talking $250 billion in automotive imports into the U.S. every year, and you've got a lot of parts content. We've seen estimates that would add $3,000 to the cost of vehicles, even those that aren't imported here. And if there's, say, a $40,000 vehicle hit with a 25% tariff, that's $10,000 if it all goes through to the consumer. So this would add cost, it would hurt profitability, and remember, car buyers are already beset by high interest rates and, pretty historically high sticker prices too. So that would just make vehicles more expensive. So we'll see where this is going to go and if Trump is actually going to do it.
I'm glad you brought up the consumer prices at the end of the day because selfishly, that's where the rubber hits the road for a lot of people here. Can you kind of give a backdrop here on how this would add pressure to a market that you've already mentioned here is struggling with very high prices already? It seems like a pretty significant problem.
It is. Look, we used to look at the U.S. car market as being somewhere between 16 and 17.5 million vehicles a year in a good year. And the last few years it's been just under 16 or at 16. And that's because vehicles are expensive. They hit a high last year of about $50,000 on average, but the average vehicle is still selling for somewhere in the high 40s. Add on top of that high interest rates, and consumers are starting to balk at these high prices. You're seeing some discounting going on, and you're just seeing people sit on the sidelines, keep their cars longer. So if you add more to that with tariffs, then more people just stay out of the market. And look, at some point you could have a market that's like 15 million units or something like that, and that means you'll see some layoffs in some plants where consumers just aren't buying, so the workers aren't busy. I think the tariffs would have to stick for a while to do that, and a lot of speculation is even if Trump goes through with this, he won't keep them long, but that's what you're looking at should he decide to do that.
Yeah, well, David, you said the key word, and that's if these happen, so we'll have to keep a close eye on that. I want to shift gears a little bit and talk about Nikola. Interesting to see the company file for Chapter 11 protection this morning. Many people might say that that's a long time coming. Talk to us about the EV landscape outside of Tesla right now. Is this a Nikola problem, or does this speak to something broader?
Now, Nikola is sort of its own special case because they were trying to do electric and hydrogen-powered semi-trucks, and both of which are pretty tough to do, actually. They were sort of in a market on their own, but they had a huge recall 2 years ago that really hurt the company, tripped up any momentum they had, and it was just tough for them to recover from it, and they really haven't been able to get the sales they need to show that sometime in the future they'll have strong enough cash flow to service any debt. So I think funding has been a problem for them. Look, they're one of the last SPAC companies, to go public with a SPAC IPO to still be around. And look, you hit it on the head a second ago. A lot of people thought that they would have gone out a lot sooner, but here we are. They're out of funding and headed to the courts.
Here we are. Thanks to David Welch of Bloomberg, of course. All things autos out in Detroit. Big time for the sector. Coming up next hour, we're going to talk about how tariffs could impact the overall economic picture. We're going to bring in KPMG's Diane Swonk. Stick with us. This is Bloomberg.
We are moments away from the start of trading after an all-time high on the S&P and the NASDAQ yesterday, not for the Dow Jones Industrial Average, so I won't even show you futures on that index. But here you can see S&P futures now down about 0.2%. NASDAQ futures down a little less. Russell taking the biggest hit in terms of futures, down 0.8%. You hear the bell on the New York Stock Exchange, Fiverr ringing the bell, which is apparently an online marketplace. You can buy and sell stuff there. Over the past 5 years, the stock is up 10%. So that's not as bad as losing money like Reynolds has over the past 5 years. They make, obviously, aluminum foil as well as trash bags and some other stuff, but maybe it's the tariff effect. Their shares are down 12% year to date and more than 20% over the past 5 years. Let's get a check on the major averages as they start trading live. We go over to Katie Greifeld. And Katie, what do you see?
Right now I see red on this screen. You can see the S&P 500 down a little bit just in the first 40 seconds of trading. As Matt mentioned, we hit that all-time high yesterday, and it was really action in the last half hour, the last 5 minutes of the U.S. trading day that got us there. So we'll see how this evolves throughout the day, but at least for right now, it's the same story. If you take a look at big tech, off about 0.2%, you have to wonder where the next catalyst will come, whether we have to wait for NVIDIA earnings next week to see it. And then, like Matt mentioned, small caps really taking a bath today, down about 0.7% right now as bond yields rise a little bit. But let's look under the hood here and let's talk about Etsy, also having not a great day, falling after revenue missed estimates, and the company faces, quote, significant headwinds from a more competitive retail environment that could impact gross merchandise sales, which dropped about 7% year over year. The stock currently off almost 6%, Sonali.
As you know, I am pretty obsessed with the consumer story. I'm going to look at another story over here. This one's interesting, Katie. SolarEdge, steep declines the last 2 years, on the rise this year and on the rise even more today. Revenue topped estimates despite dropping 38% year over year. They returned to positive free cash flow as the industry is poised for growth in 2025. Up almost 40% this morning.
All right, so that's a big jump for SolarEdge. Capri is up, albeit a little bit less, benefiting from news that Prada is evaluating Capri's Versace brand. If Prada makes an offer, that would bring Versace back to Italian ownership. Prada has emerged as one of the winners amid a global luxury sector downturn.
I'm proud of you for knowing all of those associations.
I wonder why, though. Like, is someone really out there still buying Prada handbags?
So much activity.
I assume so. I don't know. I get all my bags from my mother, so.
Right, I go to shopping in her closet. I don't even buy my own. But you know.
But let me say this, Sonali. Let's say I give you $100,000 tax free. Go buy a handbag. Do you go to like some big department store on Fifth Avenue and buy a Prada handbag? Don't you know about anything cooler than that?
You know, you're talking to both a millennial and a financial anchor. I would rather buy financial products.
That's true. I'm putting my money in the S&P 500.
But I'm saying, listen, Katie, I'm saying if I give you money specifically to buy a handbag, otherwise you have to give the money back to me, what are you going to buy?
I honestly couldn't tell you.
Stella McCartney.
There you go. Actually, I do have a Stella McCartney bag. Let's keep this conversation moving, though, because our next guest says that affordable luxury is well positioned for growth in the next year. Advisors capital partner JoAnne Feeney joins us now. So, of course, Matt Miller is confused as to why anyone would buy Versace right here. Does that fall into the affordable luxury category that, JoAnne, you are excited about at the moment? Talk us through it.
No, Katie, that one does not fall into affordable luxury. What we're thinking about here is something like Williams-Sonoma, affordable luxury. It's a bit upscale household products, and it's done very well because when you look at the consumer, you see a real break in the type of consumer and how they're spending, right? Obviously, folks at the low end and even the mid-range have been really had their budgets squeezed by the years of inflation, and they've been trading down and trying to save money. But you look at the upper middle and the upper end, and they're doing quite well. Their houses are worth more, their portfolios are worth more, and they're spending well. So in that middle range, you have a Williams-Sonoma that has upscale household products. They are extremely well-run company, and they've been able to deliver quality at not ridiculously high prices, and so they've attracted that part of the consumer element that wants to fill their houses with a bit nicer stuff. And it does come on the tailwind, by the way, of folks needing to buy new houses because there's very little in existing homes on the market.
It's interesting. Williams-Sonoma up 83, almost 84% over 1 year. So almost 90%. Nice run. At what point, JoAnne, do you get worried about the consumer? You're seeing Etsy kind of on the downside of things just today, but you also have longer-term challenges potentially when you think of these tariff threats. Auto prices alone could take a significant hit, among other things. How do you put that into your equation on how you're thinking about the consumer sectors?
Yes, no, that's the biggest risk really is many of these policy changes that might be coming down the pike. And we're not sure yet, what kinds of tariffs and how high they will be and on which sectors. But obviously the news flow coming out of Washington just does create a lot of uncertainty. So, if we get tariffs on final goods like autos and on parts that will filter through into final goods prices, that will squeeze all consumers, but more so those with less of a savings buffer to fall back on. And that could really affect the whole economy. And even more so potentially is tariffs that affect the intermediate products, whether it's steel and aluminum or the parts that go into cars or the parts that go into computers. These things will raise prices beyond just the goods on which the tariffs are placed. That will also tend to affect the whole consumer space because of the tighter budgets that consumers will then face because of those higher prices. So it's a broader effect that one really has to be wary of. And I think that's why we've seen some of the deviation in stock price performance across different types of industries that we've seen to date.
It's impossible to ignore, JoAnne, the fact that stocks are at an all-time high. So broadly, at least on a index level, they're still very high, and hopefully that means at least some consumers have money in their pockets. But even without forecasting future inflation, we're living with serious inflation now. And is that why you like an Amazon or a TJ Maxx? Are people that would want, to get the Le Creuset pan at Williams-Sonoma looking for maybe the cheaper cast iron knockoff on Amazon?
Yeah, Matt, the consumer is strong because employment's been rising, because wages are rising faster than inflation, and because more of them are employed. And so when you look at the whole consumer space, there's just more money out there to spend. Now that could change with higher tariffs, but when you look at the breakdown of the consumer, the lower end, the mid-range, those are the ones that have to save money. They're the ones that go to a TJ Maxx. They're the ones that are doing more shopping online. Everybody is shopping online, but when you look at Amazon specifically, we've seen them continuing to take share because they offer good value, and we think that's likely to continue. Tariffs could change the equation. They could raise prices even more and cause spending to be curtailed to a large degree. But that doesn't mean that you need to run away from those stocks. That's actually the place that consumers will likely continue to go.
Well, and almost everything on Amazon is made in China, right? But if Jeff Bezos continues to have dinner at Mar-a-Lago, can he get a discount?
Even though he's not CEO anymore.
He's not CEO, but he still owns the majority of the company, right?
That's true.
Or not the majority of the company. He still owns a big piece of Amazon.
Yeah.
Owners and influence, right?
I want to
Exactly.
talk more about Amazon, JoAnne, because we're talking about it through an e-commerce lens, and obviously Amazon is a huge e-commerce story, but it feels like the stock more trades based on AI, based on what AWS is doing, et cetera. So I hear what you're saying when it comes, to the e-commerce side of the business, but do the shares actually react to that?
Yeah, they do. They do sometimes. When you look at the earnings reports, we see Amazon being uplifted when they have good numbers on the retail side. And we've seen their margins really be helpful there. But to your point, the effect of Amazon Web Services is obviously the behemoth here, and they are extremely well positioned, right? And we're seeing more and more models be delivered by Amazon, and their customer base is very solid. So there's some concern about who's going to take a little bit of share here and there, whether it's Google, Microsoft, Amazon. But ultimately, this is a growing market. All three of them have an important role to play. And, cheaper models, cheaper training, cheaper inference that we saw at a DeepSeek, for example.
Some might call it
Good slip.
Yeah.
Right. Is only going to propel the use of these AI models. And that's going to be helpful for Amazon. Whether they, adversely affect the chip suppliers, I think remains an open question. We're still quite favorable towards NVIDIA and AMD as it comes up with its new chips for AI inference as well.
I want to ask you something a little off the beaten path here, because this is a market looking for catalysts. What are some names, JoAnne, that you're studying right now that you're looking for a catalyst to get into?
Yeah, we're long-term holders, right? When we talk about, owning Broadcom, we've owned it for nearly 10 years, right? Williams-Sonoma, another long-term position. So I know a lot of folks are focused on short-term catalysts, and obviously we're going to take advantage of a pullback to maybe get into a position we think is a good long-term holding. But I think the market overall is looking for some reassurance that the growth drivers, and we've seen, by the way, growth stocks outperform now, since the election, and that was a change since the July peak. So we do see investors coming back to growth, and the catalyst I think they're looking for is some reassurance that the growth names in particular won't be so adversely affected by the policy uncertainty in tariffs, for example, or in immigration. They are less vulnerable to that, and I think that's why we've seen a return to those specific catalysts. I think a lot of folks are looking for reassurance from earnings that the demand for chips, for example, for the use in AI is going to continue despite cheaper models like DeepSeek has revealed.
JoAnne, great having you. We always love talking to you about these names. JoAnne Feeney, they're talking stocks with us from Advisors Capital. We also want to check in on Intel after the stock's blistering run. Here you can see just the last 4 trading sessions up 23%.
And a little bit of today.
And I guess there's a tiny bit of today in there. What's the stock doing right now?
It's down a lot, which is why we're checking it, down more than 5%, coming back to earth.
Taking a breather.
I mean, relative to what it's done, it's up 30% over the last 2 weeks.
That's why we're talking about it, the fact that it's coming back to earth. It had its best day since 2020. Yesterday, of course, there's deal speculation. Who is going to get the pieces of Intel? TSMC seems to be in the running here, along with Broadcom, potentially. I mean, we've been talking about this, the possibility of an Intel breakup, since last year. When it actually happens, Who knows?
When it happens and who actually comes together, the TSMC part is interesting to me because of the drag that a deal might have on its own profitability. And what's more, I think this was an interesting little scoop here from Bloomberg yesterday. Silver Lake near a deal for Intel's Altera unit. So you have private equity circling. It was only a matter of time. I'm watching Apollo's relationship with Intel and seeing how that plays out. We'll see where the story goes.
It is interesting. It feels like in evaluating this, it's that the parts are greater than the sum of all of them together. At least, I mean, I don't think anyone is bidding for Intel outright. So.
It's still up.
Not yet.
I mean, since last Friday, 35%, even with today's drop. So I think this is evidence of hopium in this market.
It was down 60%
It's one more
last
of those
year.
stories where just the market wants to see a deal.
Absolutely.
And the market is fighting to see a deal, like with so many other stocks, US Steel, for example.
Yeah.
Not X, not Twitter. I wasn't talking about Twitter.
But yeah, deals, and more deals. And sometimes the lack thereof them. One fun little fact for me that I was watching this morning was Tapestry is actually your best consumer discretionary stock after the Capri deal.
Is that the owner of Anthropology?
Actually, I don't know.
Tapestry? Is that?
I don't know.
I was thinking of Carole King.
Well, there's a large portfolio.
We'll evaluate in the commercial break.
Anyways, coming up, 2025 is a big year for the IPO market, but some of the early debuts have had rocky starts. That could throw things off course. We're going to talk about details next. This is Bloomberg. This is Open Interest, and you're looking live at the Principal Room. Coming up next hour, an interview with Ali Kashani, Robotics CEO. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Bank of America is upgrading Capital One to a buy. The firm says the company will benefit from the pending Discover acquisition. Next up, Workday no longer a buy over at Morgan Stanley, with the analysts saying that there are more risks than bullish signs on the horizon. And finally, Stanley Black & Decker is getting initiated with a buy recommendation over at Jefferies. The firm notes that the power tool company has a, quote, compelling setup and sees around 20% upside. Meanwhile, let's shift gears here because that IPO boom we've been anticipating in 2025 having a lackluster start. You have 3 of the U.S.'s 4 largest IPOs this year trading below their offered price in their first session, a concern when stock benchmarks continue to break all-time highs. Let's bring in Bloomberg's Bailey Lipschultz to break it down. What's going on, Bailey? Give us the state of play.
Katie, the big thing is a disconnect from what the companies and management teams want in terms of value and what investors are willing to pay. When you look at that board you guys put up, Venture Global came into the year as kind of a high watermark, potentially looking to raise between $2 and $3 billion, fell well short of it, having to slash on the cover the amount they wanted to raise and be valued by more than 40% at the midpoint. We've also seen deals like SailPoint, which we reported were more than 20 times oversubscribed at ahead of pricing, actually falling down almost 9% in its debut. When I talk to bankers across Wall Street, they're kind of going back to the drawing board and trying to figure out what the disconnect is, because these are deals that, at least on the face of it, should be trading better than they have been.
What are the hot IPOs to look forward to? I know Sonali is very excited for Skims to go public.
And Medline and Klarna.
Yeah, I'm asking Bailey.
We're on the beat.
Bailey, what are you looking out for? What are the big IPOs to look forward to this year?
Big ones we're watching, Klarna, as Sonali mentioned, as will be Medline, maybe a little bit later in the year in terms of the next few months. But keep an eye on Klarna, Chime, CoreWeave, Medline, Genesis. Those are the names that come to the top of mind for investors and analysts, and then the bankers are more than happy to talk about all of their deals. But those are the deals in terms of big valuations that we're keeping a close eye on and what they can bring to the table, and actually what they'll end up being valued at, because a company like Chime, that $25 billion mark was a number of years ago.
Half of those names sound like they're just made up. like an Amazon product, produced in China. They just made up a name.
They're futuristic fintech companies in some ways. Bailey, thank you for following the beat so closely, by the way. I want to pull up also, if we can, Standard Aero here for a second here, because not just the first day trading, kind of being up and down for a lot of these firms. Standard Aero was something that was really helping break the market open for the private equity-backed companies. It's been up very meaningfully at the beginning. It's kind of wavered off, still above the IPO price. I use this as an example. How much does the post-IPO trading matter right now for companies who are looking to go public and looking for investors that are trying to hold for the next year, 2 years, 5 years?
Well, that's the big thing, Sonali. When you look at a company like Standard Aero, as you mentioned, we saw a strong pop and then just a few months later breaking below that IPO price. The big question when I talk to bankers and when you talk to investors are we gauging these as a success after day one trading? Are we gauging them as a success 3 months, 6 months, 9 months later? As you can see, you're still in the green if you bought at the IPO and are holding for the long term, and you do have earnings between now and when the company went public. But that certainly is not the type of a chart that analysts and bankers really would like to see. You want to see that big day one pop, but at least continuing to grind higher and up and to the right. Again, when we're coming just points below an all-time high and coming on the eve or the day after, of a record close for the S&P 500.
Bailey, we thank you so much. We're looking forward to all of your coverage. That is Bailey Lipschultz of Bloomberg News. And SailPoint CEO Mark McClain joins us on Friday at 10:30 a.m. New York time. This is Bloomberg. Time now for the Wall Street Beat. One of my favorite parts of the year now. Izzy Englander and Ken Griffin topping Bloomberg's annual ranking of the best paid hedge fund managers. They topped it for a second straight year. But Rob Citron, this one's an interesting one. He joined the top 10 after making $730 million for himself in 1 year. Joining us with more, Bloomberg's Tom Maloney, who knows what's under the hood of all of these funds, exactly how they're valued and what people are making. $730 million. How rare is that for a fund of this size?
It's unusual. He wasn't managing that much money at the start of the year, single billions. If you look at the top 10, most of those are really big funds managing tens of billions of dollars. At the top of the list, we had Izzy Englander at Millennium, Ken Griffin at Citadel, and Steve Cohen at Point72. So those are guys with huge fortunes and huge funds, and it doesn't take a lot for them to get to the top of the list.
Just crushing it.
Yeah, absolutely.
Crushing it.
Life is not bad at a hedge fund these days.
Yeah. Citron got there, though, with excellent returns, 52%, I think, at Discovery. So that's what it takes to get to the top 10.
And his fund wasn't very large, right? Last year, was it $1.5 billion?
$1.5 billion at the start of the year, that's right.
Wow.
So also, Josh Resnick of Jericho. I mean, we're hearing of names that have not been on this list before. What brought him into the list?
Again, excellent returns. So he was at 60%, which is, knocking it out of the park kind of return. He managed a little bit more. I think they're at $4.5 billion now. But yeah, again, look, just great returns for Jericho Capital and Discovery. That's how they got to the list.
So do those guys, when you put up 50%, 60% returns, does that attract a ton of money? Will Rob Citron, for example, have, $5 billion of new money to invest next year? Or does he want to keep it small so he can continue to generate that kind of alpha?
That's a really good question. Look, I think the issue with Citron is 2 years ago, they came off quite a bad year. Last year they made most of that money back, and then this year, he's had some fantastic returns. I think that volatility does scare off some investors. When you look at like Citadel and Millennium and Point72, they're just really consistently generating those kind of low double-digit or mid double-digit returns, and that's really attractive.
I think it's one really interesting thing, Katie, here. It shows you bigger is not always better. Kind of exciting thing for the hedge fund industry. And also, the talent war is alive and well. People are making money, again, big time in hedge funds.
All right, great reporting as always, Tom. Great to have you on set with us. That is Bloomberg's Tom Maloney. Meanwhile, a quick check on markets right now. You definitely have more losers than winners. You can see that reflected in the broad benchmark. The S&P 500 down by about 0.2%. Big tech also down about 0.3%, even though Tesla having a great day. That is your biggest gainer in the S&P 500 right now. Not doing much to lift these benchmarks. And small caps still on the losing side. Matt Miller currently off by about 0.6%.
All right, in the next hour, we are very excited to welcome Diane Swonk to the show, KPMG chief economist, and we're going to talk to Ali Kashani, the CEO of Serve Robotics. This is Bloomberg. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, the Department of Government Efficiency says it saved $55 billion in federal spending so far, but the data tells a different story.
Elon Musk wants to boost the valuation of his X social network back to the original $44 billion purchase price, but Fidelity marked down its investment by 70% in December.
And get ready to meet the newest member of the Apple family. Bloomberg's Mark Gurman joins us live from New York to bring us the scoop on today's big product launch. All that and more coming up, but let's get a check on these markets right now. Not too much happening if you just take a look at the index level. The S&P 500 currently off by about 0.2%. You take a look at the sector level and it's a little bit more interesting. It's actually energy that is leading the way today, up about 1.3% as a whole. Big tech is one of the laggards, currently off by about 0.4%, even though you have Tesla having a pretty good day right now. And meanwhile, the bond market, absolute crickets. Matt Miller, you can see the 10-year yield. I'm going to go ahead and call that unchanged, sitting at 4.54%.
What's that screen? I use the move screen on the S&P.
I also use the move screen.
Is that
S&P?
You just click into sectors
You
somehow?
do. We're taking a look at SPX Index MOV Go. You can find a lot of
300 losers, 200 gainers, so it's skewed to the downside. Let's talk about the economy right now with Diane Swonk. She is chief economist at KPMG. And Diane, great to have you on the program. I want to ask about how Donald Trump and his administration will bring down inflation. Kevin Hassett, we spoke with him last week, and he has said in the past that bringing down aggregate demand is a key part of this. And as I watch, federal employees get fired, I wonder if the idea is if you cut government spending and fire federal employees, does that lower the demand side of the equation? Is that part of the way that you think they want to bring down inflation?
I'm not sure what their actual strategy is, but there is no question about it that as you cut government spending, you will have an impact on the economy. I did something when I was in graduate school where I ran sort of a random experiment on something that I didn't think I ideologically agreed with in government spending and zeroed it out and saw a double-digit increase in the unemployment rate as a result, running the University of Michigan model on the U.S. economy at that time. And it was a huge lesson to me to separate my ideological views from my economic understanding of the world, and that was really important. So beware of law of unintended consequences. The more you not only lay off government employees, there is waste. We all know there's waste out there. You want to have a more efficient government and free those funds up for the rest of the economy. But the transition period and determining what is actually waste and what is efficient is more of a very strategic process, not done with a sledgehammer, and that's what the concern is right now. And I think it's very important to think about the dampening effect on demand that higher prices due to tariffs and some losses in some programs, government programs that provide support as well for spending, especially among low-income households and retirees, is going to be very, very important watching
Diane,
going forward.
That kind of demand picture, this growth concern out there, coupled with concerns about sticky inflation, paint a picture of how the next 6 to 12 months could start to look like, given the forces that we're seeing coming to the surface right now.
It's very uncertain, and that is, in and of itself, a tax on the economy. Uncertainty affects everything from how consumers make decisions about big buying decisions. They tend to hunker down and buy more necessities, not as many big ticket items. We do know that builders started to front run some of the increase in prices that they were worried about due to tariffs. Builder sentiment, housing starts came out today, very weak. That was a lot of weather, but also the housing market has been very weak, and material costs are up and accelerating in January, front running what they fear to be tariffs down the road. And so those kinds of things together, they tend to combine and do two things at once, and that is stem growth and stoke inflation. And for the Fed, that could be in its worst case scenario, stagflationary, but for the Fed, it leaves a lot of uncertainty for their moves as well, and that's why they've moved to the sidelines, trying to wait and to see which policies will have the most dominant effect. The sequencing of the new agenda that we're seeing coming out really does matter when it comes to Federal Reserve decisions.
Well, Diane, let's spend a little bit of time exploring that worst case scenario for the Federal Reserve ahead of the Fed minutes coming at 2 p.m. today. Torsten Slok over at Apollo put out a note this morning talking about the key questions that he's getting from investors at the moment. And one of those is, if inflation remains sticky and the Fed doesn't hike, what will happen to long rates and break-evens? And I'll toss that over to you, because you've seen this rise at the long end of the Treasury curve, and break-even inflation expectations have also been on the rise, Diane.
Exactly, and I think what we're seeing is sort of this nascent return of what we once called the bond vigilantes. We've seen the term premium come back into the bond market. Some of that is a normalization after a very unusual period in the wake of the global financial crisis during much of the 2010s. But we are seeing also central banks, including the Federal Reserve, are no longer the main buyers of our Treasury bonds. They were buying to hold to maturity. What we're seeing is more buyers that are more willing to demand a return on those investments. And if the Fed were to be hesitant and not raise rates in response to inflation, the bond market would compensate for them and raise rates as well. So you could see actually we've already seen the bond market decouple from the Fed, given the percent cut by the Fed since September, and the low in interest rates in September were about 1% higher in the bond market already than we were then. So they're already moving in different directions.
Diane, how do you think this, if you step back and think about the very long term, how do you think these high prices, especially in housing, high rates on mortgages, and if we get rid of the FHA, difficulty for first-time buyers, how does that affect a generation of wealth creation?
Well, we're already seeing it in the consumption numbers and in the actual home buying numbers. The average age of a home buyer last year was 38 years old, the highest on record. The data goes back to 1981, but I can guarantee you it was the highest on record. And that's important because there's a lot of angst out there, because many millennials who are moving into their prime home buying years and their coupling years. We know that much of the ability to buy homes in the wake of World War II actually also helped to spur birth rates and the advent of the baby boom. So now we're working in reverse, which has compounding effects. Not only do you miss out on moving up the rungs of the ladder of wealth, which are often for most households through their ownership of a home, you also have this issue of birth rates and coupling sort of going down. And that is another important factor, because you need young people, of course, to continue to pay for those people who are retiring and keep the economy growing. And that's something that could be undermined as we look at this process.
And I want to go back to something you had mentioned a little earlier, this idea of slowing growth. And I want to couple that also with a question back to Katie's point about Torsten Slok's key questions for investors this morning. This idea that you could, or you have to wonder whether DOGE-related firings and cuts could create a recession. Just that idea of a recession, it's not a word we've heard a whole lot again, but do you start to worry that things could slow down quite meaningfully from here?
Well, we do worry about it. There's no question that both tariffs, immigration also restrains growth, because it restrains participation in the labor force and the growth in the labor force, particularly among prime age employees. And so you put it all together, it tends to compound over time. And the problem is many of the things that the administration would like to stimulate the economy with, in terms of tax cuts and a sweetener for corporations and small businesses as well don't hit until 2026. So if you front load many of the negative effects up front and they compound over time, by the time you get the things that actually help growth out there, it may be too late. We do not have a recession in our forecast right now. We have 3 scenarios on tariffs with major curbs on immigration, and that does basically stall the economy out as we go into 26 and 27 with the unemployment rate rising because we're no longer growing enough to accommodate even the small labor force that we have.
So Diane, all these different cross currents that we're talking about, do you expect to see any discussion of them in the minutes readout that we will get at 2 p.m. in the next Fed meeting? Because the attitude and the narrative going into the last several rounds of Fed communication, whether it be at the meeting or somewhere else, is that this is a Fed that doesn't want to make news. And it just feels like this is a very fluid economic situation right now. And there's a lot of people craving that clarity and that candidness.
I think what you're going to see in the minutes is sort of some very much uncertainty and some divisions within the Fed. We've already seen that. We saw it with the dissent in December. So there are clearly some people who already are worried about, are we already at or closer to that neutral rate than we should be given the ongoing inflation pressures out there? And other people within the Feds, like Chris Waller, board member on the Federal Reserve, now saying, well, we're still pretty optimistic that we could see more progress on inflation and you won't take rate cuts fully off the table. That's a division we're starting to see that started at the end of last year. I think that last cut was really a difficult cut for many within the Fed system, and you're going to start to see those divisions come out. And again, in a period of uncertainty, it would be natural to see a much more divided Fed in terms of how they feel about the economy, because there's so many mixed signals that we're all trying to sort through. And that is what I would expect to see in the minutes as well, is that uncertainty coming through, some discussion of tariffs and uncertainty of whether they're going to push prices up, are they going to be demand destroying, what is the effect of immigration on the labor market, is that going to cause acute shortages where they're already acute as they are in home building, or is it going to have other economic impacts? So those issues are going to be flushed out a little bit without trying to stay around the politics. Chairman Powell has been very clear about not wanting to weigh in on any policies, but clearly they have to be looking at different scenarios, and he's been honest about that too and open that they're running all kinds of scenarios within the Fed right now, as are we.
Diane, looking forward to your further analysis. The reading of the tea leaves from those minutes. That is Diane Swonk of KPMG. We're also going to get a look at some stocks moving under the hood this hour. There's a lot moving. I'm keeping an eye on Toll Brothers here, taking a dip lower, missing expectations for quarterly home orders. Of course, the 30-year mortgage, guys, is still above 7%, so not too surprising. You have Toll Brothers down another 6.6%.
Yeah, it's bringing down really the whole entire index when it comes to the home builders. That index sparking a broad sell-off here, hitting its lowest in a year or two.
Is Bumble not something that the kids are using? I
don't know what's going on with Gen Z.
I thought this whole thing was, it's good because the woman makes the first move on Bumble.
That's the pitch.
So it's not as predatory as
Gen
like
Z,
a Tinder?
they don't drink, they don't date, and Bumble, I mean, it has a lot of idiosyncratic issues beyond what's going on in the dating app community. They're going through some management turnover, and it seems like those issues are working through in the earnings
Founder
as well.
bought back to the CEO post.
Exactly.
Maybe that's a good thing. And finally, of course, we're watching Garmin as well. Interesting moves there. Katie, did I get this right that you're a Garmin person?
Dude, yeah, I wear this every single day. Yeah,
I don't know the difference.
I'm a huge Garmin gal. It's a great watch. People always think that this is an Apple Watch, and I say, no, man.
Well, the stock is up 10%. I feel like you're on trend.
You're welcome.
You know what? By the way, speaking of stocks that are gaining, we were talking about Tapestry earlier, and I suggested that it owns Anthropologie.
Right, it does not.
It does not.
A wild
Anthropologie.
suggestion.
In fact, Tapestry was Coach, founded in 1941. It was bought by Sara Lee, the maker of pound cakes, in 1985.
Fascinating.
But then went public in 2001. So
great American brand. But the thing that's interesting to me about Tapestry is that it's up a lot after that
it's
deal
doubled
with Capri.
in the last 12 months.
Totally, and the deal with Capri fell through. They're fine without it.
Anthropologie is owned by
Urban Outfitters.
There you go.
We're learning our brand soup. Now, coming up, X is in talks to raise money at a $44 billion valuation. We're going to bring you the latest on the social media company and whether it can get there next. This is Bloomberg.
get now to high interest. Look at what's making headlines around the world. The Senate confirmed Howard Lutnick, the Cantor Fitzgerald CEO, as Commerce Secretary. Lutnick will now lead the government's tariff and trade agenda after being approved by a vote of 51 to 45. Lutnick named his 2 eldest sons and 3 company deputies to run the core of his business group in his absence. HSBC reported fourth quarter pre-tax profit that was higher than estimates. It also said it will incur $1.8 billion in costs over the next 2 years as it embarks on a global restructuring program. HSBC shares are trading down just a little bit this morning, but they've surged about 40% over the past year. And Guns N' Roses and Tool will support Black Sabbath's final concert in Birmingham, England this summer. The rockers signed up to join Metallica, Pantera, Slayer, and Mastodon for the July 5th charity benefit being directed by Rage Against the Machine guitarist Tom Morello. Ozzy won't be able to perform an entire set due to Parkinson's disease, but he said he'll do as much as he can. Also, Phish has announced its summer tour dates, kicking off with a 3-night run in Manchester, New Hampshire. The band will play Pittsburgh, Austin, Folsom Field in Boulder, The Shot in Columbus, North Charleston, Philly, Chi-Town, and Forest Hills right here in Queens, and then wrap it up with a long weekend at SPAC.
Wow. Matt Miller, I assume that you're taking the summer off to follow Phish around the country.
I'll be going to as many shows as I can.
I love that for you. Looking forward to your on-the-ground reporting there. But let's switch gears here, because Bloomberg has learned that Elon Musk's social media company, X, you might know it still as Twitter, is in talks to raise money from investors at a $44 billion valuation. For context, that's the same price that Musk paid for it in 2022, when it was still formally called Twitter. Let's break it all down now with co-host of Bloomberg Technology, Caroline Hyde. So Caroline, he would like to raise money at the $44 billion valuation. Does that seem feasible?
Seems feasible from what we understand in the conversations, but just think back in December, just a couple of months ago, Fidelity, which owns a load of the equity of X because it helped when it would purchase it, was still having it on its books of 70% less than the $44 billion valuation. This is a remarkable turnaround. As we see some of the banks that I know you've been tracking being able to sell the debt at face value rather than at a steep discount, suddenly tides have changed. We've decided that Elon Musk's closeness to President Trump is probably benefiting not only Tesla, which we've seen the share price rally hard, you've seen the conversation around XAI. It's looking to be raising money at a $75 billion valuation. And now we've got the tails of X coming back, and it seems to be rectifying itself.
Something that kills me also about the way investors look at X is the way they look at earnings on a very heavily adjusted basis. Are they looking at the numbers, the financials? Are they looking at vibes? Are they looking at the number of people using it?
It sounds like vibes.
It feels like vibes.
Are they, I mean, because
have they been looking at Tesla fundamentals?
Fidelity,
the
no, of course not.
40%? Exactly.
Fidelity downgraded their, or reduced their mark on an X investment by 70%. So that was in December. January, now we're in February. Is it now all of a sudden worth $44 billion again? Or do they just hope that it's worth $44 billion?
Or did they need to test the market? And the demand was there for the debt. The banks have now unloaded basically all of it. They had $13 billion of loans. They've only got about $1 billion left. Maybe people have taken some of those heavily adjusted numbers that Sonali talks about and said, oh, look, December was a nice pop, 40% increase in revenue. We had a lot of advertising around, of course, the election. Maybe the fourth quarter did well for X. Maybe we are going to be dining out a bit on vibes, but the vibes have turned into demand. People have taken on the loans, they've managed to sell them, and therefore when they're raising money, are people more willing to buy some of that equity as well? Andreessen Sequoia was some of the people who helped back that 2022 buyout. It's been 2.5 years to get back to this $44 billion valuation.
One thing that amuses me is not only the valuation behind X, but XAI and the fundraising around that is subsequently going on.
Tesla, the valuation of Tesla, as Caroline points out, is also quite amusing.
All of it is quite amusing for sure, but I think for XAI in particular, what's the relationship between X and XAI at the end of the day?
Well said, because actually X holds about $6 billion worth of equity in XAI. Maybe that suddenly becomes a lot more valuable if we're seeing the valuation of XAI increase ever more. This is about the underlying data. This is why the thesis of why Elon Musk first ever got saddled with Twitter and then X was the data that was so valuable. He pumps it in. We've just had an updating
Is
of
that
Grok.
why? Is that why Elon Musk bought Twitter?
Well, that was a lot of the theory why he thought it was so interesting to him, was the underlying data, the up-to-the-moment data that he can put in to his large language model Grok, and therefore potentially outcompete some of the others on the market.
Yeah, Grok. I haven't really used it on X, but boy,
You're a paying subscriber?
No.
It's very complimentary, isn't it? Have you ever grokked yourself?
I've done it once, and then, I was
Do you look lovely?
nice
Do you look
things.
lovely? Have you done the image generation or what it thinks you look like?
Wow.
Yeah, mine was a bit depressing.
Apparently, Grok has advanced since I last used it. Caroline, great breakdown as always. That is Bloomberg Technology co-host Caroline Hyde. You can catch her at 11 a.m. Eastern. A quick check on Tesla shares, currently higher by about 3%. That is good to be the biggest points contributor to the S&P 500 right now, but it's fighting against the tide because the index is still down. Now, still ahead, this is Bloomberg. All right, it's time now for Social Climbers, companies making waves this morning. And first up, the online freelance marketplace Fiverr beating fourth quarter estimates and guiding revenue higher. The site is also launching a new AI platform that will let creators train AI on their own body of work, not making a difference in shares, currently down by about 8.5%. Next up, Wendy's expanding the rollout of its AI bots at its drive-thrus. By the end of this year, about 600 restaurants will be using the Fresh AI system. Using AI in fast food is still a mixed bag. You have Taco Bell leaning into the technology with some success, but then you have McDonald's, which actually ended its AI drive-through test last summer. And finally, it's a Kentucky Fried goodbye. Colonel Sanders is leaving Kentucky. Yum Brands announcing that Kentucky Fried Chicken is relocating its headquarters to Texas. That's sparking backlash from KFC diehards who say that the fried chicken chain is central to the state's heritage and culture. I would love to know if they're going to change the name. It seems like you would have to.
Yeah, I just feel for the people of Kentucky if they think that KFC is central to their culture.
It's in the name.
I get that it's called Kentucky Fried Chicken, but hopefully they have more to live for.
They've got, bluegrass and thoroughbreds, but in any case, coming up, Serve Robotics. We'll speak with the CEO next. This is Bloomberg. Well, Serve Robotics is rolling out its sidewalk delivery robot services in Miami. Customers will be able to get burgers and pizza delivered by bot without having to leave a tip. It's the company's first expansion to the East Coast as part of its goal to deploy 2,000 robots across the U.S. by the end of the year. Let's talk about it now with Ali Kashani. He is Serve Robotics CEO. Great to have you back with us. So you chose Miami as the place to debut in the East Coast. Why Miami and what's next?
Miami is a fantastic city. It's lively. There's great population density, amazing restaurants. So it was just a natural place for us to get started.
What we were looking at the robots and talking about the shape today because we were wondering.
Cute little eyeballs.
Well, we were wondering how you get a pizza. Do you design these robots so that they can hold like a 12-inch pizza box?
Oh, absolutely. They fit 6 large pizza boxes, so they're very spacious.
I knew it. I knew it. The designers must have said, what are we going to deliver more than anything else? And somebody said pizza.
That's right.
Well, maybe now burgers too. I mean, how many burgers are fitting in?
Right.
You have this conversation going on now with Shake Shack as well. What do you expect in terms of demand? We're New Yorkers, so we've had a lot of those in our time here.
I think you can feed a party. Like get 20 Shake Shack burgers. I'm sure they will fit in there.
I do want to talk about NVIDIA because you have this news out today. You see that the stock reacting mightily, up about 12% right now. You had a pretty lousy end to last week, though. There was news that NVIDIA has cut its stake in Serve. That was a long-standing stake. The shares fell about 40% on Friday alone. Since then, I mean, you do have some sell-side analysts coming out and saying that, this isn't too big of a deal. They would view this as a buying opportunity, but even still, you see that share reaction, you see that nervousness among investors. What led NVIDIA to cut its stake? Have you spoken with NVIDIA about what happened there?
So I can't obviously comment on behalf of NVIDIA, but I can share a bit of the history. So they invested in us in 2021, 2022, 2023, and 2024 when we were a private company. And since we've gone public, we learned recently that they divested, along with a bunch of other small cap, public companies that they also divested from. So it's an investment decision on their part. Again, I don't really have anything to add there, but our partnership continues. We are still using their chips. We are growing with the use of their Orin chips in every robot we build. So as far as the partnership goes, nothing really changes.
Oh, well, that was going to be my question too. What is your remaining partnership with NVIDIA, barring a stake that they have in you? I mean, that was a significant relationship for a long time.
Yeah, I mean, nothing really changes about that. Again, we're using the chipset, we're using the technology that powers the robots to do all the magic that it does. So this is, again, more of an investment decision. I don't think it relates to the technology side.
I can understand that it has nothing to do with the fundamentals of your company, and in that case, it must be an incredible opportunity. You already have substantial exposure, obviously, to Serve Robotics. I think you have 5 or 6% of the company, but did you go and buy shares when they fell 40% last Friday? Have you talked to people who used that day as a buying opportunity?
I have heard from folks who did. I unfortunately am in a lockout, so I can't actually do any trades myself. So, I think that's all I can say.
All right, appreciate the clarity there. I do want to talk about another partnership you have. That's with Uber Eats, of course. That's also helping you expand to Miami. And I'm curious, would you ever be interested in a more formal partnership, Uber Eats potentially acquiring your entire business? It seems like this partnership definitely has legs.
Yeah, if for folks that don't know our history, we actually spun out of Uber a few years ago. I think the idea was that we should be able to go work with everybody, including other delivery platforms, and Uber should be able to work with other robotic platforms and AV companies. They want to be a neutral partner there. That makes sense, and for us, it makes sense to work with as many platforms as possible to bring the cost of delivery down. So I don't think that's the kind of strategy that makes sense, but you never know.
Well, to that end, when you're talking about your relationship with Uber in particular, how far can it go when you're having conversations with the delivery company, and the rideshare company? What's your pitch? What do you bring to the table in this relationship?
Look, as we like to say, you don't want to move 2-pound burritos in 2-ton cars. So this last mile movement of goods, which is half of Uber's business, and there's a lot of growth in that space just generally. It needs more optimization. It needs more cost reduction. And right now, if you order something from China, it only costs $2 to get it to your door. But if you order it from Chinatown, it will cost $10. So this is the problem ultimately we are trying to solve, is bringing efficiency and automation there. By doing so, we remove cars out of the street. So we make cities safer. We make reduce congestion, reduce emissions, and reduce the cost of delivery for businesses and customers. So it's one of those things where everybody wins.
When are we going to start seeing these robots scooting around Manhattan? If I order something from Chinatown, it's a pretty long way from 731 Lexington Avenue, but when are we going to start seeing them in these markets, or are there certain markets where it may be too dangerous to let your robots roam?
No, look, we've been operating in Los Angeles for many years, in many different types of neighborhoods. So I don't think any market is dangerous. It's just really a matter of time. We are working with cities and municipalities to make sure that they are embracing us. So we don't want to just roll out and then ask for forgiveness. This is what we did in Miami, for example. I think it's just a matter of time. We have 2,000 robots to deploy this year. We've announced, but obviously we've expanded in LA. We now brought the robot to Miami. We've announced Dallas next. And by the end of the year, I think we're going to have more to share.
All right, Ali, hope to stay in touch. That, of course, is Ali Kashani of Serve Robotics. Shares now up about 13% on the day. Now, coming up, Apple expected to unveil its latest iPhone at its launch event later today. This is as the company is racing to add to its AI system, Apple Intelligence. It's going to add that to more devices. We'll explore what's at stake in the AI race next in today's Wall Street Week. This is Bloomberg.
This is Open Interest. You're looking live at the principal room. Coming up, an interview with Microsoft Executive Vice President Jason Zander. That's at 11 a.m. New York time. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And Apple is pushing to integrate its AI system onto more devices as analysts anticipate more widespread adoption of AI around the world. David Weston takes a look at what's at stake in the race for AI dominance.
Chris Miller is the author of Chip War. He says the challenge for big tech companies isn't the money being spent, but lack of capacity.
There are two limiting factors right now. One is the chips and servers themselves, which are less in shortage than they were 18 months ago, but are still hard to come by for some of the biggest tech firms in the vast quantities that they need. The second hurdle, which is new, is actually the power to make the data centers function the way they need to. They need huge quantities of power, and as AI gets more advanced, it requires bigger and bigger data centers. And so now if you listen to companies like OpenAI or Google, they're talking about bringing online data centers that use a gigawatt of power. You need a whole power plant to power some of these facilities, and it just takes time to build all that infrastructure.
For some time, chip manufacturing capacity has been concentrated in Southeast Asia. That began to change with the Biden administration's CHIPS and Science Act, encouraging investment in U.S. chip manufacturing. Samsung is investing in a chip plant in Texas, while TSMC is opening a new plant in Arizona. Alyssa Apsel is the director of electrical and computer engineering at Cornell University.
The CHIPS Act is a response to a COVID-era supply chain interruptions that made it very, very clear that the U.S. needs to be competitive in semiconductors. Otherwise, we're going to lose out to other countries because we can't supply our own semiconductors, and we'll be beholden to other countries to supply them for us, and that puts us in a precarious position in terms of national security. The infusion of funding into the U.S., both on the research side and for companies to develop products, but also for small companies to be able to compete in this space in order to support growing this infrastructure has been quite significant, and it's really changed the game in this space.
Building more chip making and power plants is one way to get over the AI capacity hurdles. Another could be finding ways to achieve the benefits of AI without requiring the same supplies of chips or energy. Wall Street was rattled in recent weeks by a new, more efficient AI model out of China.
I think in Silicon Valley, there was actually a lot of surprise as to why DeepSeek garnered so much attention in the media and on Wall Street. DeepSeek was part of the AI conversation for most of the last half of 2024, and then just in the past couple of weeks, it gathered attention in the media and in Wall Street. I think what you'd find is that compared to OpenAI or compared to Anthropic, the number of paying customers is far, far lower, and that's where the U.S. firms appear to have a real advantage.
That was Wall Street Week host David Weston, and you can catch the full show every Friday at 6 p.m. Eastern. And sticking with tech and AI, Apple is set to reveal a new product today, and it comes after our own reporting that a new low-end iPhone is imminent. Joining us now is, of course, Bloomberg's Mark Gurman, who broke the story and breaks, let's say, everything about Apple. You know, one thing I'm wondering about is this going to kick off that upgrade cycle that everyone's been waiting for forever?
The super cycle is a lie, right? It's something that analysts like to talk about because they like to get attention, they like to inflate the stock price, but in reality, the iPhone growth has been stagnant for a number of years. There's really only been one super cycle in the history of the iPhone. That was when we had a confluence of events 11 years ago. They made the bigger iPhones for the first time, right? The 6 and 6 Plus. That's when everyone was asking for Apple to make a phablet to come after Samsung. And during that same exact period, they struck a deal with China Mobile, the biggest wireless carrier in the world, and obviously the biggest carrier in China. So those two things happening at the same time led to a massive super cycle, a massive iPhone explosion that we haven't seen again. And we're not going to see that again, right? What we are going to see is probably a slight return to growth. iPhone sales dipped 1% annually in the holiday quarter, so through December. This new iPhone coming in at around $500 with Apple Intelligence, camera upgrades, a redesign, right? Major new features across the board. I think it's going to do extremely well. Maybe it's not going to be a boon to revenue and the average sales price, ASPs, but it will do good for Apple on units, and I think it's going to be especially effective in both India and China.
Well, first of all, I love the myth busting that the super cycle is a lie. It doesn't exist. There was only one, but apparently it looms large in all of our memories. I have to say, it's going to take a seismic event for me to upgrade this. So I'm waiting to see if these features are juicy enough. But talk to us a little bit more deeply about competition. You've written about this low-end competition that we're seeing. Who are the competitors that Apple is trying to fend off right now?
So the biggest competitors are actually the companies in China. Huawei, Xiaomi, Oppo, OnePlus, they do a really good job at the mid-tier, sort of that $300 to $700 price point. In the US, you're talking about companies like Google. They have low market share, but they're A-series phones. That's sort of their lower tier phone that's going to compete with this successor to the iPhone SE. They're actually pretty good phones, and from an AI perspective, they're the best in the business. Samsung also does a really good job at the mid-tier as well. So in the US, you're competing with Samsung and Google, but the real story is who you're competing with internationally, India, China, Europe.
When is Apple going to have its own large language model or its own chat bot? I have been, having conversations with ChatGPT in my car.
Spooky.
And the one thing that I always notice is I come up against a firewall when I try and get it to do stuff on my iOS, right? So Siri isn't capable enough yet. When are we going to make that leap?
So a few things. Last June, when Apple announced Apple Intelligence, they announced the AI-ified Siri. The idea is that Siri, for the first time, could tap into what you're looking at on your screen, all the data you have on your phone and in iCloud, to get a better understanding of the information you have in your device in order to answer queries, right? That's not ChatGPT, but that's really an AI-ification of Siri. That's supposed to launch in April, but I reported last Friday that that's running into serious engineering snags and delays. So I don't anticipate that now to launch between May and June, so a little bit of a delay there.
Does that create a broader ripple effect? Because to your point, you talk to ChatGPT in your car. I talk to my Google Nest. So we're all talking to our technologies at home. I'd love to talk to my car, frankly, and let it just tell me answers back. If they don't figure this out, then does it create a problem for other product launches, especially as they broaden out into home and other wearable devices? They try to expand their product suite.
In terms of this Siri launch that was supposed to happen in April, that Siri set of features is supposed to be core to a new device they're coming out with this year. It's a smart home hub. This is a Nest competitor, an Amazon Echo competitor, something you can put on your desk or pin to your wall. The idea is that you can control it almost entirely via Siri, right? And that feature is part of this April rollout that was delayed. So that hardware may not include those features from the get-go, which would really dumb down the device and not make it super useful, really take out much of the purpose of the product. So we'll see how that all plays out. But yes, that does have implications for the hardware. But to answer, Matt's larger question about a ChatGPT like Siri, they are planning to launch a more conversational revamp to Siri next year. But in terms of the fundamentals, the LLMs you mentioned, that core sexy technology that has just, made all of us so excited, they're years away from that.
What about getting a better hold on the car consumer? We all spend a lot of time, Sonali and I are commuting and Katie's driving out to the horse farm.
Yes.
Right? So, and that's like a couple hours.
It is a long chunk of time.
And I've noticed that, CarPlay had really taken a lot of market share, or most manufacturers had offered it, and now some manufacturers are starting not to offer it anymore.
Let's take a step back. Wall Street got kind of excited when we broke the news that the Apple Car, the actual car, right, the $100,000 thing, got canceled last February, right? Because Rivian had struggled, Tesla had some struggles. They didn't want Apple dealing with a very non-profitable business. I think Apple canceling the car is going to go down as one of their biggest mistakes. I think they should have continued to invest there. I've seen the Apple Car, to some extent. And I think it would have been incredible and revolutionary, and it was a massive missed opportunity. Obviously, they made the decisions for why they made the decisions, but I think it would have been remarkable. Now back to CarPlay, right? So there's two versions of CarPlay right now. There's the OG, the original CarPlay that you talked about. Then they have this CarPlay 2, which is supposed to be a revamped system that plugs deeply into your car, can control the AC, can control your seats, can control the radio. Basically everything that you do in the main infotainment system that comes with your car, you can do through CarPlay. that's designed in a very bespoke fashion. They have to work with every car maker individually to craft a unique user interface for every car. That takes a lot of engineering time from both Apple and the car companies. So far, they've only announced partnerships with Porsche and Aston Martin. Neither car has launched that feature yet. In addition to the time it takes to customize the interface for those cars, you have a situation where car makers know that Apple comes into new industries and completely vanquishes them. If I'm a car maker, why do I want Apple in my system, right, taking my business, 10 years from now eventually making a car of their own and taking my customers, right? So it's a double-edged sword, and that's why CarPlay 2 hasn't really launched yet, despite being announced.
Brutal
Wait for this.
reality.
They announced this in 2022. We're in 2025, and it still hasn't launched.
Yeah, well, we'll see. Mark, it is great to have you on set with us. You're here for a while.
I'm here for a while.
All right, we'll be having you back. That, of course, is Bloomberg's Mark Gurman, our Apple whisperer. Now, coming up, we're going to talk about politics because President Trump set to take the stage in Miami today after widening his tariff threat. We're live in Miami next. This is Bloomberg.
President Trump is speaking at a Saudi-backed investment conference in Miami today after saying he would likely impose tariffs on cars, ships, and chips, not ships. Did you notice the difference there?
That would be huge, yeah.
Cars, chips, and drug imports, potentially ships as well, of about 25%. Bloomberg's Tyler Kendall is there on the ground. So Tyler, what do we know? We're going to get more detail.
Right, Matt. Well, we're still waiting on additional details. When it comes to what President Trump is going to speak about tonight, it will likely be around this idea of investment, considering that this is a Saudi-backed investment conference. And we know that Saudi Arabia has pledged to invest at least $600 billion over the next 4 years when it comes to the U.S. And I actually spoke to one foreign policy official on the ground here at the FII who said that this is actually a slight reversal of Saudi Arabia's current push to try to bring more investment when it comes to their domestic sectors instead of just exporting capital, but the latter helps them when it comes to making amends and continuing relations with the Trump administration. And the general sense is that they want to focus on points of agreement, such as investments in artificial intelligence and advanced manufacturing, particularly as Saudi Arabia finds itself at the center of many White House policies. Just look at yesterday and the talks between U.S. and Russia that are happening in Saudi Arabia. That is not to say that there are not still points of contention that could come up depending on what President Trump decides to do with his speech, such as his proposed plan for Gaza, as well as his recent complaints about oil prices.
I want to double down here a little bit about those talks in Saudi Arabia in particular, because there are a lot of headlines coming out this morning. Really punches thrown, if you will. You have Ukraine's Volodymyr Zelensky accusing Trump of living in a Russian disinformation space. And you have Trump, on the other hand, saying that Zelensky talked the U.S. into spending $350 billion to go into a war that he believes couldn't be won. Where is this going, Tyler?
Right, Sonali, that is the big question here, right? And when President Trump was asked yesterday about concerns being raised by European leaders as well as Ukraine about how they were not involved in those preliminary talks, his response was that Zelensky had been at the table for 3 years prior. That was met with pretty widespread criticism, particularly by our European allies. We know that Secretary of State Marco Rubio actually met privately with his European counterparts yesterday after that meeting to assure them that sanctions, for example, would not be lifted on Russia before an official peace agreement was on the table, and said that they will too have a seat at the table. But it all remains to be seen. We know that this White House is pushing for a potential leaders summit between Vladimir Putin and President Trump. They'd like to see that get on the books by the end of this month, which would just be in a couple of short weeks. That official date has not been set yet, but we're still waiting for additional details. But it's definitely taken a contentious turn as all these factors come together.
All right, that is Bloomberg's Tyler Kendall joining us from Miami. Great reporting, as always. And tomorrow, Bloomberg TV will be sitting down with U.S. Treasury Secretary Scott Bessent. You don't want to miss that one at 7 a.m. New York time tomorrow. Meanwhile, a quick check on these markets. Still lower on the day. The S&P 500 currently off by about 0.2%, a little bit more if you take a look at the NASDAQ 100, off by about 0.3%. Those all-time highs from yesterday, a little bit farther away right now, but a lot could happen between now and 4 p.m., Matt Miller.
Yeah, absolutely. Right now, losses, but it could be another all-time high. Coming up tomorrow on Open Interest, Ethan Devitt of Moneta, Nancy Dowd of Ameriprise Financial, and Fat Brands founder Andy Wiederhorn.